Hi everyone, this is Dean Holmes and Paul Barrett from Absolute Wealth Advisors. And we're here with you today just to have a little bit of discussion in and around the investment market. Specifically, we're going to start with Paul today. He's going to start with inflation because that's obviously a very important and relevant topic at the moment. And we're going to take that inflation theme through our discussion today in a few different areas to give everyone some context for what's happening at the moment. So Paul, over to you to get started.
Thanks, Dean. So everybody's aware through the news that inflation is high, and that's causing central banks around the world to raise interest rates in order to bring inflation back down into the generally agreed target range of 2 to 3%. Inflation of 2 to 3% is really good for sustainable economic activity. Inflation below 2% or above 3% is bad for stable markets and economic growth. So central banks at the moment are increasing interest rates, and for savers, that's good news. So people who are in retirement or who are relying on income from cash, term deposits or bonds are now receiving in Australia around 4% per annum for a 12-month term deposit. In the US, you can get above 5%, between 5 and 6% for cash and term deposits. And this is much better for people relying on that income. Interestingly, however, that level is below the current level inflation, but it is starting to normalize. So typically, term deposit rates would pay higher interest than inflation. But for about the last 10 years, that normal relationship has been reversed. So term deposit rates have been paying lower than inflation. And what we're seeing is markets return to normal. And that's a two-way street. Interest rates will go up, inflation will fall. And so by the end of that process, we should have term deposit rates paying a rate higher than inflation. But that's still probably got 6 or 12 months to go before we get to that situation. Over to you, Dean.
Thanks, Paul. So the next part of the conversation in relation to inflation is actually thinking about the opposite of a term deposit investor in the context of someone that's borrowing money. So a couple of things that are happening for borrowers at the moment that we've observed is that firstly, with the large increase in interest rate, what's happening when the banks assess someone's ability to borrow, their ability to borrow now is significantly less than what it was when the market was pricing interest rates at around 2 or 3%. So the statistics at the moment is that borrowers' borrowing capacity, if they want to upgrade their home or refinance their existing debt, the actual borrowing capacity in most cases has maybe dropped by 25 to 35%. And so that's quite a significant fall in people's borrowing power. If we look at the history of the increase in debt and increase in property prices, there's a strong relationship between people's ability to borrow and borrow more money and use that money to buy ever increasing house prices or ever increasing houses, and those prices are increasing. So at the moment, the ability to refinance is actually challenged. And so the market and the financial commentators are talking about people are unable to refinance existing debt. That's also translating into this other situation where some borrowers are coming off really low fixed rate loans and moving into higher variable loans. So ultimately, in the short term, this is going to continue some uncertainty around property and property prices overall. The final thing that we observe at this point in time is the relationship between interest only and principal and interest. And so for borrowers that already have the debt, most of them actually everyone's either got interest only or principal and interest. But the challenge at the moment is for people that are already on principal and interest, it's actually going to be difficult to revert back to interest only, whether that's for an investment loan or a principal loan. And that's because essentially it's a new application or a new finance application. And so we find that there's going to be some interesting challenges for individuals at the moment in terms of property prices and borrowing. And we just have to see how long the high interest rate cycle lasts to really observe the true impact on property prices and borrowers overall. So Anthony's going to talk to us now a little bit about how that inflation interest rate dynamic works with the share market.
Yeah, so the share market is broadly a reflection of what people think these companies are worth, and that's based on profitability, both now and into the future. Rising interest rates impact a company in two ways: their current profitability, because their interest repayments are going up, so that reduces profitability now, but also how analysts value companies in the future is looking at that future profitability. And as interest rates increase, the value of future profits today are less. So the value of the company today is less. And so we're seeing broad declines across equity markets until the inflationary and interest rate environment begins to normalize and move back to longer term trends.
Yep. Thanks, Anthony. And over to you, Paul, just to summarize and finish up.
So to summarize, what's happening in the markets at the moment is there are two main components to inflation. What we're calling transitory inflation, which are those rising prices that were a result of supply chain disruptions, and that is gradually coming off. So inflation is on the way down because those transitory figures, these features are passing. However, there's also a stickier component to inflation, which has got to do with rising salaries, rising food prices because of climate events, rising energy prices because of transition to renewables. And the worry is that, and the market is constantly trying to weigh up where the long-term inflation is going to end when the transit inflation comes off, where that long-term stickier inflation is, and how high central banks are going to have to raise interest rates in order to get that further down. And remembering that the risk is that the central banks have to raise interest rates too high, which causes a recession, which also damages employment, which can also damage property prices and equity prices. So where we think we are at the moment is we are still in the rebalancing phase of the inflation and interest rate cycle. And we don't know exactly how long that's going to be or how high the interest rate rises have to go. But the good news is that this will pass, and that when it does pass, we'll end up in a situation where interest rates are higher than inflation once again, that we get back to a much more normal economic environment. And that should lead to higher long-term returns once we get through this next 12 to 18 months. So the news is that unless you're in any sort of sense of financial difficulty, that if you are in a position where you're able to ride that out, and I'm pretty aware that all of our clients at this point are able to ride this cycle out, then there are better times ahead. So that's good news for the future.
Excellent. Thanks, Paul, and thanks, Anthony. If you watched the video all the way to the end, thank you. You should be watching this on YouTube. So if you can like the video or leave some comments at the bottom about what you would like to ask Paul or myself or Anthony in the future, that would be wonderful to give us some feedback. And if you have any individual questions about your situation, please always reach out to Paul, Anthony, or Stella, and they'll be able to put all of what we discussed today in context of your financial situation. Until then, have a great day. Cheers.
Bye.